Good evening, class, and welcome to our advanced taxation class for today. We are discussing capital allowances, and this is part 3. Part 3, we are going to discuss some aspect of capital allowances that we didn't touch in part 2. Now, as a quick recap, what did we learn in part 2? 1, we learned how to calculate capital allowances when we are having restrictions. When a business is not an agricultural business or not a manufacturing business, we restrict the capital allowances to 2/3 of assessable profits. Then we also learned that what again did we learn? We saw conditions for granting capital allowances. And we also learned that investment allowances are always not affecting the tax written down value, unlike initial allowances that affect the tax written down value. We talked about buildings that is being purchased, second-hand value, which does not have initial allowances, but annual allowances can be claimed. We talked about all of that. We'll now go to part 3, where we'll talk about calculation of capital allowances on assets acquired on hire purchase. All right. Now, a company or an individual taxpayer wanting to preserve liquid fund, or that his liquid fund falls short of what is required to purchase an asset at a given time, can enter into a hire purchase agreement. Now, let's say, for example, you want to buy a baking oven, and the baking oven is 150 million naira, right? And you don't have that kind of liquid fund to part with at the moment, but you need that asset. And you now enter into a purchase agreement that you are going to be paying 20 million every year for 5 years to get that 100 million naira worth of oven. Now that's a purchase agreement, because you are hire purchase agreement, because as at the time that you have not completed payments, you are using the assets. Is it as though you are hiring the assets? Such agreement usually flexes the payment, which is usually done in installments. Now, because the payment is made in piecemeal, the cost is 100 million, but at the end, you will not pay 100 million. It will attract some interest on costs. So you may end up paying 120 million. So that interest on costs is also what they call cost of hire purchase. So now this is it. This is where we look at something called substance over form. That is, if you're looking at it from the accounting point of view, substance over form. What do I mean by substance over form? What is the legal form? The legal form is that because you are hiring the asset is not in your name, it means that you are not the owner of the assets. You are not the owner of the assets. And now look at it now. In tax, we said you must be the owner of the assets as at the end of the basis period. But you look at it now, legally, it is not in your name because you have not outrightly paid for it. You are just hiring it. So it is not in your name. But what is the substance? Because we are saying substance over form. The substance here is that because this is a financial lease, not an operating lease, I will clarify that. It's a financial lease. The assets at the end of the period will eventually become yours. Okay, let's say you are using 12 months or 12 years to pay for the assets, and maybe the life of the asset is about 12 years. You're the only one enjoying the risk and benefit of the asset, right? The asset will eventually become yours. And so whether it is not legally your own as at that time you are using it, you are the one enjoying the risk, reward, you take the glory, you make the repairs, it is installed in your office or your premises, the asset is technically seen as yours. So we say substance over form, over the legal form. All right, now, because this is a financial lease, you don't have the money, you are just using it as a financial way to get this asset. Now, take note, this is not operational lease. Operational lease is that you don't have intention of acquiring the assets. You just want to use it and get done with it. It's just like somebody who go and hires a particular work tool. When he finish using it, he drops it and he goes. Just like somebody, again, going to a cyber cafe in those days to go and use their computer to work. You are using it every day for your work, but you are just hiring it. You are not going to be the owner. Unlike somebody who is going to work and you are given this work tool and you eventually become the owner. That one is financial lease versus operating lease. Now, we are looking at financial lease. Now, the cost of acquiring the asset on hire purchase will be higher than the original cost of paying for the asset outrightly. Have you decided to buy that asset the day you went into the agreement? Now, how do we calculate capital allowances on hire purchase? Now, one, the interest element must be identified and removed from the hire purchase price to arrive at the actual cost upon which calculation is based. So you see here, we must find a way to remove the interest part. We must find a way to remove the interest element because the interest element is not capital in nature. It's not capital. We have to remove this interest part so that only the capital assets, the capital part will be identified and used. Then we need to also identify the date the agreement went into operation. So that is the date of the agreement. And we will going to pay special attention to dates of payment of the initial deposits and installments. Now, sometimes the date of agreement might be a different date. Let's say you agree that the asset is into hire purchase on January 1. Sometimes the hirer or the hiree may make a deposit on that day to activate it. That is called initial deposit. Sometimes they might say, okay, no, at the end of the month, I might make initial deposit. You need to identify those dates. Then the agreement will tell you that subsequently, after the initial deposit, you will be paying equal installments. Now, have you bought something from Easy Buy before? Let's say you are buying a phone from Easy Buy, and you are asked to pay a down payment of a particular amount of money, say 25% or so of the amount of the phone you want to buy. Now that is the initial deposit. Then you are now asked to spread the remaining payment over 6 months. You are also doing the same thing as hire purchase. Until you pay the last money, you are seen in the legal form to be hiring it. But because the phone is with you, we are seen as already owning it. All right. Now, we are going to calculate amount paid as deposit and installments on due date. All right. Where there is a default in payment of an installment, identify the actual date of payment. Of course, default will attract more penalties. Determine the relevant year of assessment and related basis period for each payment. We're going to identify that. Identify and add all payments, both deposits and installments, falling within the basis period of each relevant year of assessment. Introduce each additional payment in A and B in E above as if treating a unit of assets newly acquired, and you're going to calculate initial allowance and annual allowance on each. Then, in calculating annual allowance on new additional payments, the number of years already spent by the assets must be deducted from statutory years determined for the asset for capital allowance purposes. We are going to see an example for that. But let's look at capital allowance on commencement basis. Now, in the old regime, we used to know that capital allowances on commencement, there is sometimes overlapping, because there is a reputation of the first year inside the second year. And sometimes there's a repetition of the second year inside the third year. And you have overlapping problems with capital allowances. Now, capital allowances does not obey overlapping, nor does it obey gap. So before 2019 Finance Act, we have been having problems with capital allowance and overlapping with profits. But with the coming in of Finance 2019, there is no more overlapping in capital allowance. This is because if the month is less than 12 months, the annual allowance will be prorated according to the number of months in the basis period. Capital allowances for existing business operating under going concern assumption. Going concern assumption, which means that the business is going to continue for the foreseeable future. For this class of business, the tax written down value of an asset shall be provided with relevant information related to the details of capital allowance granted to them from the first year of using them to the end of the current accounting year. So they're going to give you details about capital allowances from when they started using it up to that current year. Then details of additional assets acquired, cost of acquisition, dates of acquisition will be given to you. Information relating to disposal and tax written down value will also be given to you. Now, this will allow you to compute something called balancing charge or balancing allowance if determined. Now, look at what procedure you follow. Now, determine the first relevant tax year and allocate the tax written down value of the assets that is brought forward to that year. Now, any newly acquired assets on that relevant years, note the acquisition date. Allocate disposals to the relevant tax years using date of disposal. Then you compute the capital allowances. We are going to look at question on that. Now, when it comes to cessation of business, there used to be a gap. Now, how does this gap comes about? Before 2019, because we usually do penultimate year, we use two ways to calculate penultimate year. We use preceding year basis and we use actual year basis to find which of them will give us a higher value. And sometimes there is a gap between the penultimate year, which we say penultimate year is the year before cessation, and the ultimate year is the year of cessation. So there is sometimes a gap between those 2 years. And capital allowance do not obey gap or overlap. And so we are having issues relating to gap. But with the coming in of Finance Act 2019, there is no gap. So any period that is more than 12 months will be prorated accordingly. Computation of capital allowance for small companies. Despite the fact that capital allowance are claimable on capital expenditure used to generate taxable income, these allowances are not allowable or carried forward in the case of small companies. Such a company can only claim capital allowance on capital expenditure when it crosses the threshold of 25 million, as it will now qualify as either a medium or large company. So you see here that normally a small company, we don't pay tax, and so your capital allowances are not claimable and they are not allowable. So capital allowance is not an allowable expense for a small company. And they are not carried forward, just like a medium-sized company or large company. But the moment your revenue crosses 25 million, then you can now take them as, cannot take that company to be a small, medium company, and you cannot claim capital allowance. Then now we'll talk about carry back of capital allowance. We mentioned that on cessation of trade or business, any unclaimed capital allowance in the year of cessation, previously we used to call it ultimate year of cessation, you can carry them backward for 5 years, beginning from the penultimate year. But for now, we call it beginning from the year before cessation and 5 years backward. We are going to see a question on that. All right, so let's look at question. The first one. On September 1, 2014, Idiaraba Limited entered into a hire purchase agreement with Idiarere Limited. 10 generators were acquired on hire purchase by Diaraba Limited with 2 million naira paid as initial deposit on that date. This is followed by 24 equal monthly installments of 2,000 naira, 200,000 naira, commencing from November 30th, 2014.
Sorry, please. I'm sorry. You're too fast.
Okay, let me take the question again.
Yeah, like as you're explaining, although we will read icon pack obviously when it's time, but there are some points that you make further explanations that we always jot that I don't know about others that I jot down. So
Okay,
please,
no problem. I'm still
yeah.
going to repeat them as I'm solving this question. All those things I've talked about, I am going to repeat them while solving this question, and you will see it clearly.
Okay, then that's
So I'm going
fine.
to
Thank
repeat
you.
this question. On 1st of September 2014, Idiaraba Limited entered into a hire purchase agreement with Idiarere Limited. Now, 10 generators. Now, I want you to note this here. They wrote 10 in figure and they wrote 10 in numbers. Adopt writing your figures as numbers. 10 generators was acquired on hire purchase by Idiaraba Limited with 2 million naira paid as initial deposit on that date. So it means on this date that the hire purchase agreement went into effect, it was kickstarted with an initial deposit paid on that date. Now this was followed by 24, this is what I was saying, 24 equal, not here, equal monthly installments of 200,000 commencing from, so this is the date the first installment was paid, November 30th, 2014. The cash price of the 10 generators, so now this is cash price, was 5,600,000. Now, what is cash price? Cash price is the amount that you are to pay cash for the generator, assuming you were not doing hire purchase. This is a cash and carry amount. So if you have paid 5,600,000, the generator will go to you. They will issue you an invoice. The generator becomes your own, both legally and substantially. But what did you do? You paid 2 million. And so it was not yours, but it is important to know the cash price. All of these things have implication. All right. Idiaraba, who is the hiree, usually prepare its account to June 30 every year. Now, required, compute capital allowances for the relevant years of assessment. We are going to ignore investment allowance because it's not, okay, although this is a generator, but we are asked to ignore investment allowance. So this is what you are going to do. So what do we do now? Capital allowance. Part 3. Okay, so this is Idiaraba Limited. Computation of capital allowance for years of assessment we don't know. We'll come back to fill in this gap. So what do we do? Let us look at our payments. Our payment. We told that September 1, 2014. So let's do something here. Because this is preceding year basis, we'll come here, year of assessment. We'll come here, month. Then we'll come here, amount. So this is September 2014. September 1. So this, because it's 2014, this is 2015 year of assessment. It's supposed to be 2015 year of assessment, but this is going to change. And I'll tell you why it's going to change. But just watch for now. So just follow my thought process. This is September 2014. You have written 2015 here, right? Now, on September 1, 20, let me just put September 1. September 1, 2014. We are told that we paid 2 million naira. So this is 2 million. This is 2 million. Okay. Then, as initial deposit. So let me just come here and say initial deposit. All right. Then, this is followed by 24 monthly installments commencing from November 30th. So the next one is November 30th, 2014. How much was paid? 200,000. So this is 200,000. This is first installment. And remember, we have 24 installments. So what do? I want to identify all the installments. So let's write them. This is first installment. This is initial deposit. This is first installment. This is second installment. Of course, it's going to be in 200,000. This is going to be December 31, 2014. The next one will be January 31, 2014. Still 200,000. This is the third installment.
15.
February 28. Sorry, this is 2015.
2015.
Pardon. This 2015. It's 2015. Another 200,000 is going to be the fourth. March 31st, 2015. This is 200,000. This is going to be the fifth. This is April 30, 2015. 200,000 is going to be the sixth. This is May 31st, 2015, 200,000. This is going to be the 7th. Then we have June 30, 2015, 200,000. This is going to be the 8th. Now, let's hold on and go to this place. We are told that the account is prepared June 30th every year. So it means that as at this point, an accounting year has ended. This is June 2015. So this means this is 2016 year of assessment. That is what it means. So we have now seen the beginning of our year of assessment is 2016. So let's go and start here. This is going to be 2016 to, we don't know yet. So now before we proceed, this is what we will do. There are 8 installments. Let's bring the calculator down. There are 8 installments here. Here's this calculator. Somebody is asking the question. Okay, yeah. There are 8 installments. So this is 200,000. That is from the first installment down to the 8th installment, multiplied by 8. This would have given us 1,600,000. This would have given us here 1,600,000. 1,600,000. Now remember, this initial deposit is still here, 2 million. So this 2 million, we've calculated just from here, first installment to 8, give us 1,600,000. 2 million is initial. If you add them together, this is 3,600,000. So in the first year, you have paid in 3,600,000. Now I want to do something a bit different. This is 2017 year of assessment. So this is June here. So this should start from July 31, 2015. You are going to pay 200,000. So this is going to be the 9th installment. Now, I want us to do something. 9th installment. Now, between July, this 2017 year of assessment started from July, right? And it will end in June. So what it means is that from July 2015 to June 2016 is 12 installments. So what happens here?
200
It
times
means
12.
that this is going to be from 9 plus 11 more, which means 20 installments. So it means from the 9th installment to the 20th installment. So July 30th, 2015 will be the 9th installment. Now add 11 more installments to follow this 9th installment. You will arrive at the 20th installment. So what I will do here is, I will just say this is July, this August 31, September 31 down to June 30, 2016. So all of these is 20,000, 200,000, 200,000. So you would have gotten, so this is from 9th to 20th. So 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. That's 12. So all you need now do is 12 months multiplied by 200,000. It means 2.4 million has been collected here. 2.4 million. Now, this is 2017 year of assessment done. Then the next one is 2018 year of assessment. Now that will start with July 31, 2016. Of course, it's going to be 200,000. That will be the 21st installment. Remember, they said it's 24 equal installments. So this is going to be August 31, 2016, another 200, that is 22nd, September 30, 2016, is another 200. This will be your 23rd, and this is October 31, 2016, 200,000. This is going to be your 24th. So 200 in 4 places, 2, 4, 6, 8. So this is 800,000. That is what you are able to collect in 2018 year of assessment. So now you are going to calculate to 2018 year of assessment. All right. So what do we do? What do we do now? First of all, let us calculate. So A, calculate all expected cash to be paid. All expected cash to be paid. So here we say year of assessment, and I will write, yes, Mercy Okon, your hand is up. Let's hear your question.
Good evening, sir.
Good
So,
evening.
I don't want you to go too far, so I don't drag you back. That's why I just decided to raise my hands up immediately. Please, the breakdown we did for the instrumental payment, I'm not very sure I get it. So I understand that in the first year, if you could just go up a bit, that's for 2016. We started from 1st September 2014, right? And going by the rule, I'm assuming that it's preceding year basis, right? So if we did the initial deposits and then the following month, which is November, we paid the first 200, right? And we counted 200 up until the 9th month, right?
Up to the 8 months, up until 8 installments.
Oh, okay. Okay, so my first question is, why was it up until 30th June?
The
Right.
question is
Because I thought it
because
would have been 12 months. Okay.
it's prepared, your account is prepared June 30th every year. So up until the date of your account.
Okay.
So it's everything is supposed to end 30th June. So this
Mm.
first set of accounts ends on the
Right.
accounting year end.
Okay. Okay, which is in 2015. That is
Yeah.
why the year end. That's why the year
Basically,
of assessment is 2016. Then
16.
the second one is now continuing from July 2015 to
Yes. So from
30th
July
June.
to another June, which is
Okay.
12 months. So let me write it here, 12 months. 12 months. So instead of writing all these things one by one, this is July, August, September, up to June the next year is 12 months. And
Okay.
that means from
12.
ninth installment, add 11 more installments to ninth installment to give you the 20th installment.
Yes.
So it means that the
Okay.
year of assessment collection ends at 20th installment. So if you have
Okay.
been paying 200,000 each month,
Mm-hmm.
paid 2.4.
Okay. Okay. Then we continued into 2018. So, but because
So,
we paid 20 already in the past, so we just have 4 months to.
yes,
Okay. All right. I guess. Thank you.
you get it now. Very good. Now let's see year of assessment. We'll now see, let's say, let me just call your basis period. Okay. Then we'll call this one amount. Let's say remarks. So this is 2016. So it's supposed to start. We were not told that the company started their business on this date. This is the date it went into hire purchase. So it means this is supposed to be June. Okay, July 1, 2014 to June. Let me write it legibly. This is basis period. So this is July 1, 2014 to 30th June 2015. So this is the amount. This is remark. So now this is the basis period. So we have amount here. Let's say initial deposit. Initial deposit is 2 million. I can say September 2015. Eight monthly installments. I have 1,600,000. I can say November 2014 to June 2015. I can come here again. 2017 year of assessment. This is the same thing as 1st of June 2015 to 30th June 2016. And I will say 12 monthly installments. That is 2,400,000. So I can say this is, I might decide not to write anything here because the basis period covers, I still write July 2015 to 2016. I can come here again. 2018 year of assessment. This is going to be 2016 to 30th June 2017. Now, we only bought it for how many months? Only 4 installments, 4 monthly installments, which is 800,000. So this is from July to July, August, September, October to October 2017. Okay, 2016. Okay, so if you look at it, this 8 plus 4 is 12. 12 plus this 12 is 24. So that's how we got our 24 monthly installments. So what do we do now? These are the expected cash to be paid. So let's add all of them together. So we have, where's our calculator? There is 2.4 million already, which is this. So let's not remove it. Let's add this 800,000 underneath it. Okay, it becomes 2 million. Sorry. Let's start again. Let's start from beginning. 2 million plus 1.6 million plus 2.4 million plus 800,000. That will give you 6,800,000. 6,800,000. So this is total cash expected. Now the next thing to do is less cash price. Now cash price is the price of the assets as if you were buying it on September 1, 2014. If you have paid cash, this is the money you are going to pay, 5,600,000. So let's say 5,600,000. This is the cost of the assets. But you have paid 6,800,000. The extra above 5,600,000 is interest. So let's find the extra. 6,800,000 minus 5,600,000. That gives you 1.2 million extra. 1,200,000. We call this one higher purchase interest. So this is higher purchase interest. Now, this higher purchase interest is the total higher purchase interest you are going to pay for the whole period. This is the higher purchase interest you are paying for the whole period. Now, let's narrow it down to higher purchase interest per month. Higher purchase interest per month will be 1,200,000 divided by 24 months. Now take note, you do not count the month of initial deposit because this 2 million didn't yield interest for you. It didn't, it means that out of that 5.6 million, you paid 2 million. And so there was no interest counting on it. It was from the remainder from the 24 months that you paid interest. And so those interests you paid, now it means that this 2 million you paid initially is a capital payment. This is capital. Why the rest are not capital? Because the rest have both capital plus interest in it, meaning that this 1.6 million, some part of it is interest. Some part of this 2.4 is interest. And some part of this 8, that is what accumulated to give you 1.2 million as interest. You're going to see it. So now let's check it out. 1,200,000 divided by 24 months gives you 50,000. Let's check. 50,000 times 24 is 1,200,000. So let's see. This means that this is per month. So this is 50,000 per month. So what it means that in every month, you are paying 50,000 as interest in whatever you are paying. So it means that for the 24 months, you have accumulated 1,200,000. Okay. Now, let us calculate the capital element. Okay, let's go down. Now we have identified interest per month. The next thing is to look at capital payment. Capital payment per month. Now, how much are you paying monthly? You are paying 200,000 naira every month. So it means you will say monthly payments, you will say capital plus interest is 200,000 less interest per month. So the interest per month is 50,000 that you are paying every month. So it means that 150,000 is the capital portion paid monthly. So it means that whenever you pay 200,000, 150,000 of it is capital and 50,000 of it is interest. Let's test it. Let's look at it. If this is true. 150,000 naira every month multiplied by 24 months gives you 3,600,000. If I also include the initial deposit of 2 million, which is also capital, you have 5,600,000, which is our cash price. This is our cash price. And our cash price is the capital amount you should have paid if you are buying the asset now. So you see here now that we have separated our money into interest and capital. Now, why are we doing it like this? Let's recap the process we just did. The first thing we did was to identify all the months involved in the 24 installments and the year of assessment that they all span into. Taking notice of our account year end as cutoff for each year, we now looked at how much was paid. We brought a summary of them, and we noted that initial deposit is capital payment, and all the other ones are in both capital and interest. We calculated the total expected, which is 6,800,000, and we remove it from the cash price, which is purely capital. So this is capital and interest, 6,800,000. We remove it from cash price, which is only capital, and we derive our interest, pure interest of 1.2 million. This is the total interest for the period. We broke it down to 24 months to get 50,000 per month. This is very important. We now look at, for every payment you make of 200,000, 50,000 out of it is interest as calculated. That means 150,000 out of it is your capital. Now, this discovery will help us to calculate capital allowances. All right. So now we are looking at the assets. This is generator. And the initial allowance is 50%. Let me write it down here. Initial allowance is 50%. Annual allowance is 25%, which is like 4 years. We know that from previous lectures. All right. So let's see what we'll do now. We are now going to be calculating capital allowances year by year. So this is computation of capital allowances. So we start with year of assessment 2016. So we have already seen the basis period that side. So whether we put the basis period is in material. So I will come here and say costs of assets. Now, what we are going to do is the cost of the assets, this 2 million is a capital cost. This 1,600,000, we are going to take only the capital part. Now, this is how we are going to do it. Cost of the assets, we will say initial deposits, that's 2 million. Monthly installments. We know we have 8 months that we did. Let's be saying it to be sure. We have 8 monthly installments. So it will be 8 months multiplied by 150,000. because we are told that each time we make a 200,000 naira payment per month, each time we make a 200 payments per month, it amounts to 150 as capital expenditure. So 8 times 150, so we'll say 150,000 multiplied by 8, that gives me 1.2 million. So this is 1.2 million, 1,200,000. So you add them together, this gives me 3,200,000. That's our cost. Okay? All right. So what do we do next? We will calculate initial allowance. Initial allowance. That's 50% of 3,200,000. That will give me 1,600,000. 1,600,000. That's my initial allowance. Then my annual allowance, let me call it AA, will be 25% of 3.2 million minus 1.6 million. So you see here, 3.2 is the cost. 3.2 is the cost. 1.6 is the initial allowance. So you minus them. So 3.2 minus 1.6 is 1.6. So 1,600,000 multiplied by 0.25, that is 25%. 400. So this is supposed to be 400. But I'm not going to use 400 for this month, for this period, because we didn't use full 12 months. What we did is that this asset started being used from September 1. Even though we paid 8 months installment, we started using the asset from September 1. So from September to July the next year, so we have September, October, November, December, January, February, March, April, May, June. 10 months. 10 months. So we are going to take 10 months out of the 12 months. So for this first period, this first one, we're not going to take the whole 400. So we'll say prorated for 10 months. So that would be 10 over 12 times 400,000. So after this year, subsequently, we'll be taking the whole 400,000. But for this particular one, we will take 10 months out of 12. So we'll say 400 times 10 divided by 12. So that will give us 333,333. So that will give us what's that again? 333, 333, 333. That's your annual allowance. So when you add it with this here, it will give you 1 million. Okay, let me put it down here. So let me tag this as total capital. Why is this thing like this? Sorry. All right, so this is going to be total capital allowance. So this plus this gives me 1,933,333. Now that's your, I can put it down here still, 1,933,333. So that's your total capital allowance for that period. So your total capital allowance is this for the first year. So you will go to the next year. So I'm going to put this one here in brackets because I will be looking for the tax written down value. So the next year is, what's this year? It's 2016. To be year of assessment, 2017. So we have tax written down value. Now the tax written down value will be the cost here minus your capital allowance. So what's our cost? Our cost is 3,200,000. So 3,200,000 minus 1,933,333. That will give you 1,266,667. 1,266,667. So 1,266,667. Let's verify. That's it. All right, so we've gotten tax written down value. Then we'll have costs of assets. Now, the cost of assets is the assets that is the installments that you paid in 2017. In 2017, you paid 12 monthly installments. So this is how we are going to look at it. Cost of assets, you will say 12 months times 150,000, which is a capital payment, instead of 200, because you have stripped off the interest and you are having 150 as capital for each. So 12 times 150,000. That gives us 1.8 million. So I will 1.8 million. All right. So when you add these two together, the total should give me, let's see, 1.8 plus 1,266,667. That will give you 3,066,667. 3,066,667. 667. So that's your total. I will come below it and I will say initial allowance. Why are we doing initial allowance? Because we brought in a new cost. Now, this is not a new generator that was bought to, but because you made capital payments, you are taking that as a new cost of the asset. New cost. Initial allowance will now be 50%, 50% of this new cost you brought in. 50% of 180,000 will be 900,000 out of 1.8 rather. 50% of 1.8 million. That will give you 900,000. And that's your initial allowance. Now your annual allowance, take note. Annual allowance. We'll start with the oldest asset we bought. We'll now say bought in year of assessment 2016. Now, when we are talking about year of assessment 2016, is this asset that we bought that the annual allowance was 400,000? You know, we brought tax written down value before. It was because we prorated the first year and we carried down some figures. Now, 400,000, this one that was brought in this year, 2016, we have been charging 400,000, although we prorate for the first year. In the second year, we are going to take the full amount. So bought in 2016, we have 400,000. Then we'll come again. Bought in year of assessment 2017, which is this particular period. Now we have it as the cost is, we are going to be looking for 25%. Okay, so let's not look at it this way. Even though I've used 25% in the first instance, let's look at it this way. Let me not use 25% like this. Let's look at it this way again. We have 1.8 million, 1.8 million minus 900,000. Now, divided by 3 years remaining. So it is the same thing as saying here, if I go back to this first one here, instead of using 25% here, I can as well say divided by 4 years to still give you 400,000. So let me stick with that. So 1 year have gone. You are dividing it by 3 years. So I will come here, 1,800,000 minus 900,000. That will give me 900,000. Then divided by 3 years, 300,000. So that will be our annual allowance. And remember, it is full 12 months, no proration. So that will be 300,000. So we add these two, it gives us 700,000 as our annual allowance. When we add 700 to 900, we have 1,600,000 as our capital allowance. So our capital allowance for this year is 1,600,000, and I will take it down here, 1,600,000. Somebody's asking a question. Let me see what the question is. So why are we dividing by 3 years as opposed to 25%? Okay, so look at what I mean here. Let's come back again. Let's use here to answer this question. Your annual allowance is 25%. And I said 25% is 4 years. How do we get the 4 years? So your N, which is the annual, which is the number of years, is the same thing as 100% divided by annual allowance percent. So to get the number of years, it's going to be 100 divided by 25. And that's 4 years. Now, N, the number of years which you can claim the assets is 4 years. So why are we dividing? So now I said, instead of doing 25%, I can put 4 years under. I achieve the same purpose. Now, the reason why I'm doing it is that in the next year, it's not supposed to be 25% anymore. Because it's that same one asset. He didn't buy new assets. That asset has lived 1 year. It is now going to the second year. It means it has 3 years remaining. That's why we divided it by 3. If I had to use 25%, it means I'm still dividing by 4. So I adopt that style instead of multiplying by the annual allowance rate. Please always convert from the percentage to the number of years. Now, as the asset is being entering the next year, the useful life will reduce by 1 year. So it has reduced to 3 years. So this new amount you brought in is to be divided by 3. Meanwhile, the old one which you calculated was divided by 4. We prorated, but in the second year, we are bringing this full 400,000. Now, this one, we don't need to prorate because it is 12 full months, and we take the whole 300,000 with the 400,000 from the previous one, making 700. When we add the initial and annual allowance, we have 1.6 as our total capital allowance. So this for which year? 2017. Then we have year of assessment, 2018. We have our tax written down value. And what is that amount? The tax written down value is going to give me 3,066,667. Oh, sorry. All right, let's clear. 3,066,667 minus, let's see what the capital allowance was, 1,600,000 minus 1,600,000. That will give me 1,466,667. That will give me 1,466,667. 466,667. All right. So what happens now? Initial allowance and cost of assets. So remember when we are doing it, this was supposed to be 4 installments. So it's going to be 4 multiplied by 150. Okay. So that's going to be 600. So the cost, I'll write it down here, sorry. 600. So the cost is going to be 600. So when you add them up here, 4 plus 6 is 10. Take it down here, 2. Let me just do the calculation instead of, let me just add 600 to it. 2066667. 2066667. And that's your cost. So the next thing is to calculate your initial allowance. Initial allowance is going to be 50% of 600. That will give me 300. Okay. Now your annual allowance will start, but from year of assessment 2016, we have 400,000, but from year of assessment 2017, we have 300, but from year of assessment 2018, we will now calculate 300 minus 600 divided by 2 years. Just a moment. Let me plug my laptop to charger.
$600.
Okay. Now divided by 2 years. So 600 minus 600,000 minus 300,000 to give me 300. Now divide by 2. That will give me 150. I'm going to take the whole 150. Even though we brought only 4 installments ending in October, we use it to the end of the basis period. So we are going to bring the whole 150. So the whole 150, the asset was not sold. So we're going to bring the whole 150,000. When we add it, 4 plus 3 is 7, 850. So 850 becomes the annual allowance. When we add initial and annual, this will give me 1.11 million 150,000. That is your capital allowance. Capital allowance for the year. If I bring it down here, 1,150,000. Okay. So let me do the last year. 2019. So it means I will go and change this. Sorry. It means I'm going to go and change this thing that we are calculating from which period to which period to 2019. Because it's relevant also. All right. So we'll start with tax written down value. And what is it going to be? We have them here. 2,066,667 minus 1,150,000. That will give me 916,667. 916,667. So it's going to be 916,667. Now, of course, we have finished paying, so there is no cost. Neither there is any initial allowance. So what we'll do here is annual allowance. We will now say from year of assessment 2016, that's 400,000. From year of assessment 2017, this 2016, this 2017, 300,000. 4 plus 3 is 7. From year of assessment 2018, we know it's 150. So this is supposed to be 850. But look at it here, we have 900 and this. So what you would do here, you simply add all of this. This will give me 850. Then you will say additional allowance, annual allowance. Because this is the last year. This is the very last year. Because it's a 4-year asset. This is the last year. You must claim all the allowance. Now, why are we having additional? This is because in the first year where we prorated, that 2 months we didn't take is what is affecting us. That 2 months we didn't take, sorry, the 2 months we didn't take, if you can look at it here, out of the first month, which was 400, we took 10 months, which amounts to 333,333. If you want to really know 400 minus 333,333. This is the amount we didn't take, 66,667. That is the amount that we have not taken. That is the amount we have not taken. So if we are to bring it, 66,667, what would that be? Let's see. 66,667 plus 850. That is giving us this 916. But you see, you are not taking the whole amount. This is because the asset has not been sold. You must keep at least 10 naira per asset in your books. You must keep at least 10 naira less residue, which is 10 naira per asset multiplied by 10 generators, which is 100 naira. So this is your total capital allowance you are going to take. So when you add all of these together, this is going to be, we have added this one, let's minus 100. So we are going to take 916,567. 916,567. 916,5. Let me write it a little bit down. 916,567. So this is your capital allowance. 916,567. At this point, you can go ahead and put your tax written down value. So your tax written down value is 100 naira. So far so good. You have done capital allowances for the whole of the relevant period. The whole relevant period, you took them systematically. Let's run down on how we were able to achieve this systematic calculation. Okay? Let's run down again. First of all, we were able to look at the year of assessment and the months where payments came in all these years of assessment. We noted the initial deposit as a capital aspect. Then we noted where the installment started. The first installment started November 30th and goes down to October 2016. We marked them off at the June 30th end of year. And we noted how many monthly installments are in the period. Now, after getting all of this, we now did a summary. We now calculated everything and did a summary of all of these things on a simpler way. The years of assessment, basis period, and the monies that came in. Initial deposits, monthly installments for each year, and we derived our total expected cash to be 6.8 million. This is all the monies you are going to pay, inclusive of interest. So there is capital and interest payment inside this 6.8 million. Now what happens? you deduct your cash price, which is the cost of the asset originally. This is the capital cost of the assets. When you remove the capital cost from the total expected contains both capital and interest. If you have now removed the capital element of 5.6, you are left with the interest element of 1.2 million. Now, you know that interest was paid for 24 months. You divide it by 24 months to know the interest per month. This is important because we were paying 24 monthly payments. Each monthly payment was 200,000 every month. So if 50,000 is interest per month, if you remove the interest element from it, we are only getting the capital element, which is 150. And it's important because we want to look at capital expenditure so that we will get capital allowances. So it means all interest elements should go from the payment we have paid to, we are stripping off the interest element to get only the capital element so that we can work on it to get capital expenditure and calculate our capital allowances. Right? Then we come to each year. The cost of the asset for 2016, we had initial deposit of 2 million, which is a capital expenditure. We can bring that. Then for the 8 monthly installments, we strip away the interest element and take only the capital element. The capital element is multiplied by 8 monthly installment gives us, we add it to the initial deposit, gives us a total cost for that year, 3,200,000. Now we look for the initial allowance. Initial allowance is 50% of the cost for that year. 50% of 3.2 million, which is 1.6. Annual allowance for that year is going to be the cost for the year minus the initial allowance divided by the number of remaining useful life. We said annual allowance is 25%. We convert it from 25% to 4 years. 4 full years. If we are to divide it by 4 full years, we are going to get 400,000 per year, full 12 months. Now for the first year, we are only using the assets for 10 months, only 10 months. And so we take 10 months, giving us 333,333. That's our annual allowance. We add it to the initial allowance, we got a total capital allowance figure. For the next year, we had to remove the total allowance from the cost to get a tax written down value. Then we got to bring the assets, which is the installments we paid for that year. We made 12 installments, multiplying by 150 capital elements, 150,000 capital elements, we have 1.8 as our cost for that year. We'll look for the initial allowance of that cost. 900,000, that is what it resulted to. And we look for the annual allowance. The annual allowance, you bring the first allowance, which you are carrying forward, 400 from the previous year. Then you do the one for the current year. You do cost minus initial allowance. Now divided by 3 years, not 4 years anymore. 3 years, because it's that same asset. You brought them in 2024. Just that you are paying on higher purchase. This is different from when you bought an asset fresh in 2017 year of assessment. Now, this is not a fresh asset. You are just paying higher purchase. So it means it is 3 years remaining in the asset. you divide by 3, you have 300,000. You use the asset for 12 full months. So no prorating. That's 700 total annual allowance, giving you a capital allowance of 1.6. Then you go to the third year, you do your capital, you do your balance or tax written down value. After getting your tax written down value, you have how much is that? 1,466,667. Okay, then you bring the cost of the assets again. The installment payment at 150 each, 600. That increases your cost. That increases your balance, I mean. Then you look for your initial allowance for the year. 600 was the new cost. 50% out of that is 300, your initial allowance. Then your annual allowance, you bring from the first period you have been bringing from 400. This time 400 comes in full. The second year, 300 comes in full. The third year, look for your cost minus initial allowance, giving you, what did I write? I write, it's supposed to be 600 minus 300. I'm going to write the opposite. Sorry. So this is going to be 600 minus 300. Yes. It's in thousands here. Maybe I should do it in thousands so that we will appreciate. 600,000 minus 300,000. Now divided by 2 years. That gives us 150. Now remember, we use the asset fully for that year. So we add everything, that's 850. Our capital allowance has come up to 1,150. Now in the next year, which is the last year, we are finished paying. So we bring our tax written down value of 916,667. Annual allowance, we brought 400 from the first year, 300 from the second year, 150 from the third year. When we added them together, because this 2019 is the last year, because it's the 4th year, and we are supposed to claim only 4 years. As at that 4 years, you are supposed to finish claiming the assets. But we have 850 as against 916. We didn't sell the assets, so there's no way, there's nothing to calculating balancing allowance or balancing charge. No, the asset is still with us. We have 850. We then remembered that in 2016, we prorated, we took only 10 months. The remaining 2 months need to be claimed now. So that 2 months happened to be 66,667. But of course, we don't need to clear everything to make it 0. We need to leave 10 naira per asset in our balance. And the question tells us that there are 10 generators. So 10 naira per asset times 10 generators makes it 100 naira. So we're going to deduct 100 from this additional annual allowance we brought. So that will give us 916,567. So that's what we did here. So it is giving us a tax written down value of 100. Now, the next year being 2020, we are just going to carry down the tax written down value. There will be no initial allowance. There will be no annual allowance. We'll be carrying this 100 naira indefinitely until the asset is sold. Then we can now calculate balancing charge. We can now calculate balancing charge or balancing allowance. We will not be calculating balancing allowance because you cannot sell the assets below 10 naira, except if you have given it out free of charge. Then you will not claim your 100 naira. But if you have sold it, any amount you sell, you will remove your 100 naira and you charge the asset on balancing charge. And that way, you have your balancing charge reported to you. So this is the only question we are going to take now because our time is well spent. In our next class, which is going to be part 4, we are going to take just questions. We are going to do so for now, let me just write part 3 ends here. I'll say part 3 ends here. Okay, so in part 4, we're going to look at this question number 2 and see how it is going to be done. Okay, then we'll look at a question where carry back of capital allowances were being applied. So we are going to look at that and we are going to solve those 2 questions. Then when we do that, that will conclude our topic, capital allowance. So our next class will be the final class for capital allowance, such that subsequent classes we will be combining capital allowance with profit and other things that is being given to us because we have built proficiency on capital allowance. So thank you so much for joining me in today's session. It has been a wonderful session with me. If you have any question, feel free to ask now, or you can ask in privately via WhatsApp. So now I'm going to stop sharing so that we can say our goodbyes. Thank you so much for the wonderful class.